Since childhood, we're handed a specific script for success. Go to school, get a degree, land a job, and buy a house to build equity. But for many, following this script leads to a surprising result: decades of hard work that never seem to translate into actual wealth. To understand why, we have to look at how money actually flows through a household. In his book, Rich Dad, Poor Dad, author Robert Kiyosaki centers his strategy for wealth generation on a single principle he calls Rule Number 1. You must know the difference between an asset and a liability, and only buy assets. Strip away the complex accounting jargon, and the definition is straightforward. An asset is anything that puts money into your pocket, whether you are actively working or not. On the other side, a liability is anything that takes money out of your pocket. It doesn't matter what a bank or a real estate agent tells you its market value is. If it costs you cash every month, it functions as a liability. Apply this test to the house you live in. Every month, money leaves your bank account to pay the mortgage, property taxes, insurance, and routine maintenance. Because it represents a constant drain on your cash flow, your primary residence is a liability. Contrast that with a rental property. If the rent collected each month covers the mortgage, the taxes, and the maintenance, and still leaves a steady profit, that property is putting money into your pocket. That is a real estate asset. When millions of people mistakenly label their biggest liability as their biggest asset, they lock themselves into a cycle of debt. This foundational math error is why the middle class remains financially stuck, regardless of how high their salary grows. This brings us to a cycle known as the rat race. Often, when people start earning more money, they immediately use that new income to purchase more expensive things that require ongoing monthly payments. This cycle is known as bracket creep. A promotion at work prompts the purchase of a larger dream home. That larger home triggers a higher property tax bill. Then comes a new car and credit card debt for furniture to fill the extra space. This diagram shows how cash flows. The path loops from your salary into liabilities like mortgages and out as expenses. You work entirely to pay the bank. The wealthy prioritize the opposite side, moving earnings into this asset box to produce independent cash flow. Increasing your salary without understanding this cash flow pattern does not solve financial problems. It merely makes you run faster inside the same rat race. In 1974, McDonald's founder Ray Kroc gave a guest lecture to a group of MBA students at the University of Texas at Austin. After the talk, they went out for drinks, and Kroc asked the students a simple question: "What business am I in?" Ray Kroc clarified his actual model. McDonald's primary business was real estate. The restaurant served as a mechanism to acquire and hold valuable land at major intersections across the country. He was illustrating the difference between your profession and your business. Your profession is what you do 8 hours a day to earn a paycheck. Your business is what you do with that money once it hits your bank account. For the financially secure, a day job has one specific purpose: to generate the initial capital required to build an actual business, which is their asset column. If your focus never shifts from your profession, your daily labor enriches the company owners, tax collectors, and mortgage lenders, rather than yourself. The strategy is to keep your day job, strictly avoid lifestyle inflation when you get a raise, and systematically redirect all excess cash into acquiring true assets. Think of every dollar that enters your asset column as a new employee. This kind of employee never sleeps, it never takes a vacation, and it works 24 hours a day to generate even more dollars for you. This mindset changes how you handle luxuries. The poor and middle class often buy luxury items on credit to look wealthy. The rich build their asset column first and buy luxuries last. When Kiyosaki's wife Kim wanted a new Mercedes, she waited 4 years, investing in real estate until the extra cash flow from her apartment buildings was high enough to cover the car payments entirely. In this framework, a true luxury is a reward for successfully developing a real asset, rather than an impulsive purchase that digs you deeper into debt. But even if you master building an asset column, there is a legal mechanism working silently in the background, designed to drain middle-class wealth. The wealthy, however, use a hidden loophole to bypass it. Hit the subscribe button so you don't miss our next episode breaking down exactly how that tax loophole works. And let us know down in the comments, before watching this, did you believe your house was an asset?